Hello and welcome to the Corcoran Codex, which is my YouTube channel where I look at all kinds of interesting and topical ideas in the world of finance. In this video, I want to look at the charts. I'm going to take the technical perspective here, and specifically one known as the Ichimoku perspective. And I'm going to look at the charts of Coca Cola and Pepsi, where there are some interesting patterns. This is in early January of 2026. And I'm also going to tie this briefly into some recent events in Venezuela. So let me begin by giving a brief characterization of the Ichimoku technical chart patterns. And I'll talk about the key components, or essentially what are called lines of this particular pattern. So there are the following lines. This one is called the Tenkan Sen, also known as the conversion line. And what that does is it looks back on the previous 9 periods. It takes the highest high and the lowest low and then calculates the midpoint, so over a 9-day look back period. The Kijun Sen, also called the baseline, does the same idea but now looks back over a 26 period. The next line is known as the Senku Span A, sometimes called the leading span A, and it is calculated by the average of the 2 lines above. The Senku Span B, sometimes called the leading span, and this one looks at the lowest low, highest high over a 52-day look-back period and calculates the midpoint. And the final important line is called the Shiku span, or lagging span, and basically what that is the current close but projected back 26 days, and this line is useful for confirming the trend against past price action. So in terms of the cloud, which you'll see in a moment on the charts I'm about to show, the space between 2 of those lines, the Senku span A and B, is known as the cloud. This is the unique part of this particular indicator because it is projected 26 periods or days, let's say if we're looking at daily charts, into the future, giving a forecast of potential support and resistance. The price is said to be in a bullish mode if it is above the cloud, and typically that would be a green cloud, which I'll explain briefly. A bearish price pattern is where the price is below the cloud, and typically where the cloud would be pink. Consolidation is when the price is inside a cloud, and that would really be what we might call a step aside zone, probably not useful to trade. And the other component of the cloud is the support resistance. A thick cloud suggests strong support resistance. A thin cloud suggests weak support resistance. Here are some basic trading signals. A buy signal occurs when the Tenkan Sen line crosses above the Kijun Sen. Those are 2 of the lines I just discussed. And a sell signal occurs when it crosses below. Now, for a buy, this is the kind of key idea. For a buy, the price should be above the cloud, preferably near to an exit above a pink cloud where the price has moved above the cloud from below. And for a sell, it would be below this idea, preferably near to an exit from a green cloud above. And the other line, the Shiku span, should be in open space. It isn't blocked by price candles from 26 periods ago. Let us look at this particular chart. This is from January 5th, 2026, and this is for Coca Cola daily chart. And you can see the Tenkan Sen line, the one I discussed here, the blue, this one here, and you can see the Kijun Sen, this would be this one here. We have the 2 span ideas, the Senku span A and B. Now, if the Senku span A is above the B, we get a green cloud. If it's the opposite way round, we have a pink cloud over here. Now, just to briefly describe the price action in recent times, we can see here that this move above the pink cloud from below actually began a significant move up towards this level just above 72. In the most recent price action over the last few days of December 25 and going into the new year, we've seen 2 or 3 down moves, and we've now dropped below the green cloud. So this is an exit of the candle below the green cloud from above, which is essentially a bearish signal. Also look at the similar chart for Pepsi Cola, and we can see once again the blue line is the conversion line and the red line is the baseline. And importantly, we see a crossover here. And if you remember from two slides back, this is actually a bearish crossover. So we have that bearish crossover there. We also actually drop down below the green cloud, another bearish pattern here. And it's also worth mentioning, by the way, that we have a kind of a bearish flag formation here as well. So basically on both the charts we've looked at, both Ichimoku charts, you can see that Coke and Pepsi now appear to be in a bearish mode. Interestingly, I could tie this kind of chart action into a recent development in the markets, of course, involving the deposition of Nicolas Maduro, by the American authorities at the beginning of 26. Now, Pepsi and Coca-Cola could be said to feature somewhat in the story, and analysts, or a couple of analysts, have pointed to this. Venezuela was historically one of the most profitable soda markets in Latin America. A decade of economic instability shifted the landscape from high growth profit seeking to more cautious local strategies involving partnerships with domestic companies and distributors in Venezuela. Before the deposition of Maduro, both soft drink firms were reportedly assessing or reassessing their strategies to modernize plants and restore distribution networks that were damaged during the adverse economic times. But it's also worth pointing out that only 13% of the total revenues from either of these brands come from Latin America. And if you take just Venezuela on its own, the number is probably closer to 1 or 2%. So even though the analysts try to maybe make a case from a fundamental point of view as to why Pepsi and Coke might be behaving in a bearish manner, I think we have to temper this by looking at the overall impact of the events in Venezuela on the fundamentals for Coke and Pepsi. Finally, to move away from the Ichimoku idea to just a more standard price chart, we can see here that we have for Coca-Cola a drop down below. This is the Bollinger Band. These are the Bollinger Bands here, and we have a price drop below not only the bottom of the Bollinger Band chart, but we also see that the price action on the 5th of January dropped actually below this green line, which is the 200-day moving average. The chart for Pepsi is not quite so bearish in the sense that we have moved to the bottom of the Bollinger Band channel here, but we also have found some support, but who knows for how long, at the 200-day moving average here. This is the green line extending across the chart. It would be premature to make too much of this analysis. I am personally somewhat reticent to draw any conclusions, especially about the tie-in with Venezuela, but it is quite interesting that in both cases there have been chart patterns that have, if you like, preceded the price action. And we have, for example, here quite a clear example of a breakdown from a bearish flag formation, which also brought us, as I say, down to the bottom of the Bollinger Band channel down here. Well, I hope very much that you found that Ichimoku-inspired discussion of Coke and Pepsi to be interesting and of some value. I will be developing more videos on the Ichimoku pattern as well as other technical analysis patterns. And could I also encourage you to subscribe to my YouTube channel, the Coca Codex, where I analyze critical ideas and episodes in the world of global finance. Thanks very much for watching.